Let's build freedom!
G'day everyone out there in podcast land. Today we're going to be talking about deductions and how they work and trying to demystify some of what sometimes looks like voodoo for you through Lawrence and MDB. So Lawrence, tell me what's okay, what's not. Sometimes people say you need to get a dodgy account, you need to get a good account. Obviously your job's to make sure everyone's doing the right thing. What do you see as some curly whirlies that you see people trying to pass on a deduction?
Yeah, so there are quite a few things where people try to circumvent and say, oh, but it's related to my business. And yeah, some things I actually agree with what my clients say. I'm like, yeah, it's like that helps you make money and increases your business. But unfortunately, we can't go off what we want. We have to go off what the government and the legislation and everything else says. And the first principles is always that if we're going to incur expense, it has to have a direct connection with us making more money. So that's sort of where we start off firstly, but then there's a massive amount of rules around if, but no.
It depends.
It depends.
Yeah.
And just so many things where, because people always try to game the system, so the government's just made a lot of different rules. Like one of them is, even around, a lot of people might say, oh, I want a Lamborghini because if I go to networking events, then, that's going to make me more money. And I have seen clients where by having a car going to a prestige car club, it's actually legitimately made the money.
I've seen this, yeah.
But you got the people in Canberra and that they say no. So it's very hard to sort of claim a luxury vehicle just for the fact that you're going to networking events.
Well, not to be repeated, obviously, to anyone that's listening at home or in the office, but back in the day when I started my business, I was concerned about having two mobile phones, one for personal, one for business, even though they were both unlimited. And I thought, well, I have to still split the expenses because I'm still using them both differently. Is that kind of still the same game, or is it sort of changed with items that can have minimal expense per month, but ultimately are used in two different areas where you do have a bit of a luxury in having that there?
Yeah, so there is a bit of a difference between if you're a business owner running a business and then if you're an employee. Simply because some of the simplified rules around for employees, if they got work from home, then your mobile phone, your internet, that's all considered in that set rate method if you want to use that method. So that way you can't actually claim your internet or your mobile phone separately. If you were claiming it separately, or if you run a business and you're not doing your work from home, the correct way is to calculate how much is personal use versus business use. Mm-hmm. But generally a lot of people with businesses, if they've got a business phone and they use it majority for business and it's only the odd time they might use it personally.
Friends, man. I'm not going to be using it personally.
Yeah. Well, like if your friends are clients and
exactly right.
Talk tax stuff when you talk to them or whatever else, or in your case, IT stuff. But in those sorts of cases, if it's very minor, then, generally would claim the whole thing. But if it's something where it is a lot of personal use on that mobile device, even if it is through the business, then we should be apportioning between the business use and the personal use and only claiming the amount that we use for legitimate business.
That makes sense. And I'd say particularly, I'm using mobile phones as an example, but I'm going to get back to the Lamborghini because I think that's a great group. Everyone wants a Lambo. Who doesn't want a Lambo? But
yeah,
on mobile phones, you can buy a mobile phone plan for $30. I could buy a personal phone plan for $5. And I could say proportionally, I potentially never use a personal phone plan, but maybe I do. Maybe I don't. If you're spending the $30 or $50 or whatever it is, arbitrary amount on the business plan, it's still sometimes beneficial to just make the calls through the business plan. If it's an unlimited plan, the personal plan's an ad hoc $5 plan, or where does the gray area become there?
Yeah, and that's probably weird because the way our tax system works, it's the onus of proof is always on yourself.
Yeah.
So, in those cases, it's unlikely that you're going to get chased up. But if we wanted to go to the letter of the law, then it's one of those things where the law stipulates the private use. You need to remove that. But if it's something that's super small, then it's going to be immaterial. Like if you talk about a $30 mobile phone plan, for the ATO to go do an audit, then for you to go get that adjusted for 20% personal use that might be there. It's an immaterial type thing. It's uneconomic to chase it anyway. So in those really small little things, that's probably, where it is a little bit in the gray area, but it's more that you're not at an audit risk. when we're talking about Lamborghinis and stuff like that, where it's a bigger amount or a bigger sum of money, especially with like motor vehicles are very hard on the hammer at the moment with the ATO, especially because, with big data and everything else, what they do is they feed all the registrations from all the states and territories. They look at every single one that's in a trust or a company. Then they put that against their system. They have a look and say, oh, these are private vehicles. Has that trust or company submitted a FBT return? So it's a fringe benefits tax return.
Yep.
They see that there's no fringe benefits tax return there. So they just hit people with a
Finger.
Yeah, they just say, please explain, because the vehicle that they're looking at is not an exempt vehicle for FBT purposes. It's a private vehicle. So they expect that, there's going to be some sort of private use, or even if there's no private use, that you'd expect a nil FBT return just to sort of protect yourself, but they're just seeing it as, no FBT calculation done. A lot of people don't do it. Unfortunately, there's, some people, either the clients say to their accountant, no, I don't want to do it, or some of the accountants don't fully bring it up because they're super busy and they're not looking at every little detail.
The I's crossing the T's, so to speak, yeah.
Yeah. So sometimes if those just go missed, or what I've seen in some cases, I've seen this like two different ways. One case, you'll have a motor vehicle in the company account that it's actually owned by the director, so it shouldn't even be there. But then what's the more dangerous one, this is where people get picked up on and they can go back a fair bit, is when someone's bought it in the company for whatever reason, but they've never actually claimed it through the company, they've never put an expense through the company, they actually forgot that they put it in the company name.
Just got the loan and that's it.
It's just either the loan or the cash or whatever, and then the ATO's come to them and said, where's the FBT return? And then they've tried to go after them for that, and then, if time's elapsed, they can, do their own determinations because the time period's elapsed and you haven't done all the right compliance steps, and if you don't have the right records, it can be a costly exercise. So I always recommend before you buy a vehicle or anything like that to go check with your accountant
Double check.
first.
Because it could just be as simple as, depending on the industry, obviously, but it could be the difference between a Ute and a Tesla as to whether and the types you're able to claim up front. Is that correct?
Yeah, and with the electric vehicle exemption as well, there's also now a difference between if you do get a Tesla.
Yeah.
There's a difference between the Tesla like Model S, which is your more expensive Tesla, and like a Model 3, because of the any electric vehicles under the fuel efficient luxury car tax limit are now disregarded for FBT. So you still have to do your FBT calculations and everything, but the tax payable will just be disregarded. So that's how they're doing the electric vehicle exemption, just to try and get more people to buy electric cars.
Makes sense. I feel like Australia's a bit late to the game on the electric vehicle movement, but it's good to see they've got some elements in place to keep the ball moving along.
Yeah.
I'll tell you foolishly. So I started my first business, first ABN registered in 2002, so 23 years ago, and it was a sole trader ABN. And I'm sure you see all this sort of stuff all the time, different business structures. And one of the things I having foresight, and hindsight's always 20/20, as they say, is for some of the investment choices I would have made, I would have done those through a trust rather than having that leveraged off of my own goodwill and potential downfall if something goes wrong. What do you see as sort of some consistently made problems or ways that structures could be better? Do you see people doing the same thing time and time again, whether it be trusts or P2A LTDs or other interesting structures, which I'm sure you know a lot more about than me? I just know what I've learnt through fire. Where do you see the time people need to have that discussion while we're talking about depreciating assets and things like that? When should they be having the discussion around business models to make sure they're set up for the future?
Yeah, so I don't have any issues if someone's just starting something up, they want to stay really lean, they're making less than 100 grand a year just to go in a sole trader and test it out, because keep all the costs down and everything. Where the issue is that some people will just jump in and go, oh, I want a company because the company sounds cool. Like
P2A LTD sounds like you're a boss.
Yeah, it's like, I want to say I'm the CEO of whatever P2A LTD. So they just go use whatever online service, they get a company, they have all the shares in their own personal names. And then, they decide, I want to buy an investment property, so I want a trust.
Tack that on, personal trust?
Yeah, tack that on. But this is the issue, right?
Family trust, yeah.
Where they missed out and where the planning step was, where they could have had a much better structure, is that now that business is worth something because they've got, they might be making $250,000, $500,000 a year, whatever it is. So that business is now worth a substantial amount of money. So, and with that income, they're like, oh, cool, I can start investing, invest outside my business. But the issue is that they'll then want the trust to own their business, so the shares in their company.
Mm-hmm.
But if we did that, we'd have a capital gain event. So what that means is whatever the value of the business is at that point in time, just say we valued it $1 million, that is now a capital gain event to move that business into the trust that they want.
Yeah.
Whereas if they would have just set up that trust when they set up the company, there'd be no capital gain event.
Yeah.
That trust, they would own the company, give them extra layer of protection, and then they can use that trust as their investment vehicle. So that trust would be invested in their company, but also then be invested if they want to buy property, if they want to buy shares. And there's a few little strategies that we can do with the ownership between flowing through dividends from the head company down through the trust, and then down into any of the individuals, beneficiaries that are part of that family trust. So that's where I see a few of the mistakes where it's not planning for the future, they're just planning for it now because it's like the shiny object. The other thing that I see as well is that some people will go into partnerships.
In business, yeah.
Yeah, but they'll do it through just a partnership agreement in their own two personal names. I personally don't like partnerships just because you're taking all the risk for yourself and your partner, and all that risk is in your personal name.
And your partner's partner, potentially.
Yeah.
Yeah.
Yeah, so there's like, you're exposing a lot of...
With joint homes and other things like this, and someone does something silly, you might lose everything across all parties. Is that fair?
Yeah. So that's where I look at planning as well. And what you brought up with like partners and like the primary place of residence and all that, a lot of people will say, oh, let's have both our names on the title for whatever reason. If you're a business owner, it's the dumbest thing you'll ever do.
Yeah.
Because what I like to do and what I prefer to see is that if you're the business owner and you're the director of your company, you have a certain amount of risk that you hold. So you shouldn't have anything in your name.
Yeah.
And if you have a partner who's working, even she's just taking he or she is taking the salary out of the business, or they're working completely for someone else, then you trust the primary place of residence, that should be in their name.
Yeah.
Because then they're
mitigates the risk.
Yeah, it mitigates the risk. So that's another big issue that I see around structures. Because when we set up structures, one, we want to look at what's the most tax efficient way, but also how can we protect all the assets? How can we protect the business? Because we don't want, there's always going to be something out there. Someone might try and sue you. Something might happen with staff or employees.
Hopefully not.
But you never know.
Possible.
Like I try to be like a skeptical optimist. Everything's going to go well and
Plan for the worst, expect the best.
Yeah, exactly. But just in case something does happen, it's always good to just have those contingencies there. Because you never know. And especially now with like there's director penalty notices that the ATO has as a tool. So if you don't pay super, if you don't pay PAYG for employees, the ATO can make you as a director personally liable. So they can sort of go through that, what used to be called the corporate veil, as in, whatever the liabilities and everything is in the company, that's it. You just liquidate it and move on. Those days are done because the ATO, they got tools where they'll, if you haven't lodged your stuff on time, if you got money owing and you haven't sort of done the right steps and paid it or gone to a payment plan, the ATO can come after the directors personally. And then if you're held personally liable as a director, then your assets are exposed if they want to go a little bit further into you. But I've had a case where a client of mine, they owned nothing in their own name. And unfortunately, because of COVID, they were in a bit of a bad situation and we had to liquidate their company. But
they still have the Lambo?
Their wife still has a Lambo. No, they never had a Lambo. They were actually very responsible. It wasn't sort of one of those things. It was just more so they were in Victoria, and with all the craziness that happened there, it just really impacted their business. But the actual they had two cafes that were owned in family trusts. And that wasn't in his name. It was actually the service company that employed everyone. So that had all the ATO liabilities. So that's what we had to liquidate. But because of that asset protection strategy that we had in place, we actually managed to keep the two cafes alive. And we just had sort of a new service entity come in to take everything over. So it was actually his parents that ended up taking it over. But by just sort of rejigging it, we managed to keep 20 people employed, keep 2 cafes open. So no one lost their job. There was no loss of the like the actual cafes and everything, because the forward movement of the cafes was profitable. It was just this skeleton. It was just this hiccup, this skeleton in the closet from 12 months prior that was affecting it. But ultimately nothing was lost. And with him, the ATO can issue director penalty notices. But
they're pretty lenient on things like this. Like, obviously they understand. They're not like, what, COVID? This didn't happen. Not on my watch. Like, they understand these things have happened. Do they hit you with the full force of the book, or are they lenient?
So this is what I always tell my clients.
Yeah.
If you don't want to pay or you can't pay, still make sure that you lodge everything on time. Because I've had times where I've tried to explain to clients, they're like, I'll give them their best, and they're like, I don't have the cash flow to pay it. I'm like,
I know, I can see your books.
yeah. But I'm like, I know that because, whatever reason, I go, let's put a payment plan in, or at least let's lodge it, because as long as you lodge it on time, the ATO will be very lenient. So this client here, the issue is that he didn't lodge on time because he didn't sign his BASs and everything because he couldn't pay it and all that. And then we got it all up to date because he was going through a few of his own sort of issues where he sort of disconnected from us for a little while. So some of his BASs were late, and because they were late, then the ATO, what they'll do, well, what they can do, so this is more in their protocols, is that they'll issue, so with director penalty notices, there's sort of 2 types. There's what's called a lockdown and a non-lockdown. So a non-lockdown, you have a lot more options to do a whole heap of things, and you have more sort of provisions to then go into payment plans, pay everything back. If it's a lockdown, it pretty much just goes back into the director's personal name. And
that comes down to just the severity or the amount of offences or something, or
the lodgements. So if the lodgements are late, and if you get a non-lock, so if your lodgements are up to date, you get a non-lockdown.
Okay, that's good.
As long as you deal with it or interact with the ATO within the time period, they're normally very lenient. As soon as you either ignore that or you have had late lodgements and they give you a lockdown, then that's pretty serious. That's when they'll go after you, and that's sort of where you'd be looking at closing up shop if you can't pay those debts and everything that's due. As long as if you get like a non-lockdown, you do have other tools that the ATO has given for leniency with the COVID time. So there's like a small business debt restructuring process where if you're in good standing with the ATO, sometimes they'll wipe 80% of your debt, so you only pay 20 cents in the dollar. Sometimes a little bit higher or a little bit less than that. But that's more in the insolvency space. We'd speak with an expert. So we've got a few different people that we work in with who are specific to, they're allowed to do those small business debt restructures, whereas we're not licensed to do that.
That makes sense. And I guess and what we're talking about here isn't necessarily just about people that are in business as much as it's people that have any passive income, whether it be an investment property or anything that could encroach on their own personal belongings. Is that fair to say?
Yeah. So with the investments, that's sort of where we look at the separation of ownership. So that way, because where the ATO is going to come after people is like, their individual names for employee, like all the employment entitlements. So if you're an employee yourself, you're actually very low risk. So if you're an employee yourself, there's not really much that the ATO is going to come after you unless you don't pay your tax bill.
But if I've got like an investment property and there's steps that have been made by the previous owner, and the tenants that I've got in that investment property fall down those steps and they go to sue me, and that's in a trust, would I have any more protection if that was owned directly by myself?
That's where it gets a little bit tricky. So
I made it very, very specific.
Yeah, no,
this isn't a thing. It hasn't happened, but
yeah. So like one of the things is like the reason why I say it's a bit more complicated, just because that's very heavy in the legal space, and maybe 20, 30 years ago it would have been it's just in the company and or the trust or whatever, and it doesn't matter. Whereas now the issue is that lawyers have found ways to unravel all those things when it comes to personal injury, especially if it's more severe like deaths and all those sorts of things, then it can be a bit a bit more tricky to, they still like to make directors liable and bring in as many people as possible.
That makes sense. And like, so tell me, Lawrence, MDB's been around for about 40 years, is that right?
Yeah.
And you've gone through an absolute game changer over the last couple of years in bringing in new blood into the business and changing, I guess, the way that people look to accounting. And part of that is opening up flagship Brisbane locations. If there's anyone around Brizzy, what would be the best way for them to get in contact with you?
Yeah, so the easiest way is just to go to our website, mdbco.com.au. I just got a booking link, literally the first button that you see, and then you can actually book in and have a quick 15-minute chat with us, and then we can help out that way.
Perfect. Well, I definitely think it's going to be very valuable for a lot of people. We'll make sure to put that link into our blog article as well as on the podcast there for anyone that is tuning in digitally. Don't look at that while you're driving, obviously, that'd be silly. But I think it'd be valuable. I'm even concerned about some of the sort of stuff I've had set up now and how long it's been sitting there in the traps. I'm sure there's going to be some capital gains events which I'm not looking forward to in the future.
Yeah.
And tell me, Lawrence, what would be one of the reasons you do the voodoo that you do? What's something that really makes you wake up in the morning that is the game changer for you? It could be a book, a resource, or anything that you'd like to share with the community around how they can be the best version of themselves in business.
So actually, one of my business coaches, he wrote a book recently. It's called Business is War.
Okay.
And what I really like about it is that so many people, they'll write different books about, oh, this is how I was successful. Oh, this is, look how good I am. His book, Business is War, is all about like all the failures that he's had, all the failures that other businesses have had. Because I think it's like the best is to learn from other people's failures and like learn from other people's mistakes before you go into business. And I think you can learn a lot.
Years of time and experience learning from other people, 100%.
Yeah, so I think learning from all the mistakes. So it's called Business is War by JT Fox. You can just grab it on Amazon. Really good read.
It's a read or an audible, because like I like to sort of differentiate between the two. Sometimes I've fallen into the traps of getting like an audible downloadable, and I'm listening to it in the car and it says reference figure 17, and I'm like
So there's no audible out for it.
Okay.
It's just a printed book.
Even better. No distractions.
Yeah,
I love it. Well, I'd love. Thank you for being on the podcast. I really enjoyed your time here, Lawrence. And if anyone does have any interesting questions, if you're open to it, I would love you to jump to our Facebook and LinkedIn groups so that we can field any of those questions and keep doing the video that you do. And everyone out there in podcast land, stay good and stay positive.
Sounds great.
Thanks for being on.